In this video, I'm going to show you a 10-year backtest trading credit spreads on the SPX and RUT using nothing but a simple moving average. And not only are we going to do the last 10 years, we're also going to see how this strategy performed during the 2007-2008 financial crisis, and you're going to be really impressed. Make sure you watch the whole video so you get all the details and all the nuances. We're going to go through the overview of it. We're going to look at the back test. We're going to talk about the strikes and the strategies. We're going to really kind of dive in here. If you don't have time to watch the whole video now, make sure you share, like, or even subscribe to the channel so you can finish the video. And at the very end, we'll take a look at an actual trade setup on how to put this trade on. So all that and more coming right up. All right, so we're going to start with just a few PowerPoint slides. I want to talk through the strategy first, how it works. You know, it's pretty simple. This isn't going to take very long. And then we'll look at the back test for about 10 years. We'll look at it during the financial crisis, how it did during that period. And then we'll maybe take a second, jump on the charts and look at, you know, kind of actually what this looks like. Let's just go through a couple of things real quick. So first of all, the goal, you know, for this strategy is why I'm kind of adding this to my repertoire, if you will, is I'm looking to increase trading opportunities so that my position size can be small, so that when a trade does blow up, and trades will blow up, that I can stay profitable over time. And this strategy really focuses on the probability. So we're looking at historical data for the probabilities, which I think you're going to find pretty impressive. So we're trading the probabilities, and that's really the best way for consistency. If you guys have already traded options before, you know that there's a lot of probabilities involved with the deltas and things, and we'll maybe talk about that a little bit. And the other thing to stay profitable over time is that you got to trade liquid options that can scale. So this is why I'm always looking to trade SPX, RUT, or SPY. This study, we're going to look at SPX and RUT. Doesn't mean that this won't work with other stocks. The point is we're focused on liquid options so we can get in and out so that we're not giving money back up due to slippage or too many commissions as well. And obviously, having a proven specific trading plan that is easily tradable is necessary for consistent profits too. The cool thing about this strategy is there's literally only one indicator, and you can almost just start trading it at any time. And I'll show you what I mean in a minute here. So real quick about SPX and RUT. SPX and RUT are liquid cash settled indexes with weekly options. And because they have weekly options with several days a week, it allows us to be flexible and consistent with our strike selection and our expiration cycle. So for example, if you're only trading monthly options, in this strategy, we're going to look at taking a trade with 30 days to expiration. Well, if you're halfway through an expiration cycle, you may have a cycle that's 15 days to expiration and 45 days to expiration. So when you try to backtest that, you can get inconsistent results. So by trading SPX and RUT, where we have multiple days per week and multiple expirations, we can kind of stick to our 30-day cycle, which is what this credit spread strategy is going to be based off. The only indicator we're going to use is the 50-day simple moving average, and I should put in there daily chart or something. 50-day, right? So we're using daily charts. And for this strategy, the way the back test is going to work, it only did one position at a time. This doesn't mean you can't put on multiple positions at a time. It just, that's what the results we're going to see. I had one position at a time. And then once you were into the trade, we're going to set a profit target, and then we're just going to let it go and not touch it. And then once it closed, we'll open another one. So again, we're not, it really removes the decision making out of the strategy, which can be helpful over time because then you're not worried about what to do. As long as you're buying into the probabilistic outcome and the law of large numbers, then you'll be able to trade this pretty easily. Here's the strategy, and it's almost too simple. So the entry, right? The entry, when the price of SPX or RUT is above the 50-day moving average, the back test considered selling a low delta 30 put credit spread with 30 days to expiration. So this is the key here. A low 30, it could be delta 31, it could be delta 29, but you want to be right around 30. That's what the backtest did, with about 30 days to expiration. Again, this won't be exact all the time, but this is what the backtest looked at. You'll see in a minute with the other results, but the reason why I chose delta 30 is because it's out of the money, which increases your probability, but it's not so far out of the money that when you have one to go against you, you totally give back, months and months of gains. That doesn't mean that you're not going to give back gains once one of these blows up in your face, but over the past 10 years, this has been profitable, and I'm going to show you that in a minute. Okay, so once you're filled, you sell the spread, you're in it. We're going to put a GTC or good till cancel order to buy the spread back for 50% of the max profit. This is what the backtest is going to show us. So if we sold a spread, let's say we sold the 2700 2695 put spread, and we've got $1 credit, then we would look to buy the spread back for 50% or 50 cents. So whatever the credit is, you want to buy it back for half. And by doing that, you've gotten the meat, or I should say the easy part of the credit in there. And then once you close it, if you're still above the 50, you could just open a new one, right? So that's the goal, is to get out, take your profit, and look to enter a new one as long as the conditions are there. And the only condition is we're looking at when price is above the 50 SMA. So this strategy we're going to look at today is strictly put credit spreads. In another video, I'm going to do some bear call spreads, but the criteria is going to be different. So make sure you subscribe to the channel if you want to get caught up in that, or maybe join me over on Patreon and put all this stuff over there first. But the key to this strategy is the position size. And the reason why is because you can't have a couple losers in a row. And if your losers are, the losers here are about 3 times as big as the winners. And so you want to be positioned to have losers or multiple losers in a row. So the position size is key. You want to be consistent with your position size. If you want to trade one spread and one strike wide, that's the smallest you can trade. You're going to be risking about $400, maybe $385. You're going to be risking about $385 per trade. That's the smallest size you can do with SPX. So if you want to widen it out, that's great. But that's what you need to be prepared to lose, is maybe, let's call it $400. But you're going to have several $70, $80 winners, and that's what makes money over time. And again, we'll look at the results here in a minute. We're going to look at a 10-year backtest from the day, or the time I posted this video, and we're going to look at how this performed during the 2007 through 2009 financial crisis. So before we dive into the backtest software, I just want to give you a little bit of information. We're going to be using the CML Trade Machine to do the backtest. If you're interested in getting the software for yourself, check the description of the video, and there'll be a link in there if you want to check that out. I'm going to show you how to use it today for that backtest. So just so you know, CML is a paid subscription software. The fact that you can get 10 years of option data and run technical analysis backtests on it, that's why you're paying for that, because you can't get that really anywhere else. There's a couple other platforms, but I found this one for this particular type of study is pretty good. I personally pay for this software, but I'm also an affiliate, so I want to be really clear here. And we're going to take a look at how the software works and how to configure this backtest and some of the other options for different types of moving average studies, okay? All right, so let's flip on over to the software. All right, so I'm now in Chrome, Google Chrome. That's the browser I use. And I'm logged into the CML software. It's a software that you do completely in the web browser. You don't have to download or do anything. It's all in the browser. And I'm going to build the strategy. So right now, we enter our ticker and the strategy, but first thing, I want to go through the technical open. So this is an option. There's some other things here that they have, but let's go through the technical open. And the one we're testing today is when the stock price is above the 50-day simple moving average. And you can see there's several other moving averages that are built in. You can do crosses up. You can do, I know another one that I've been looking at was when the price crosses up through the 10-day and the 10 is above. This actually gives you more of a frequency of trading, which did really well. And that also worked well if the price crosses down through the 10 EMA and it's below the 200, that's when we get into bear market stuff. I'm going to make another video on bear market stuff if we ever have a bear market again. But anyway, we're going to keep it real simple here. There's some bunch of options, but we're going to say if the stock price is above the 50-day moving average, that's the technical open. So it's going to open a trade, and then it's going to stay in it and then close it, and it's going to open another one if that condition is true. Okay, so what we're going to be doing is we're going to be selling a put spread, and let's just do we'll just do SPX first, and I only have it I set to 2 year, but gains we're going to set to 50%. So once we're going to open it immediately. You can see the software's already start to use. So once we've reached 50% of the max gain, it's going to close the trade and immediately open a new one. So what it starts to do is it starts to churn through the data, and this can take a while, especially if you're doing like 10 years. That's why I wanted to do 2 so you could see it. And while that's doing that, I've set the deltas here for what I wanted to look at. You can change the delta if you want to do delta 20 or delta 10 and see, I think it's riskier because it's too far out and the risk is high, but whatever. But you can see I filled in delta 48, 45, 41, 35, 31. This is the sold strike. So this is the option you'd be selling in a put spread. And then this is the option you'd be buying. So it judges the width of the spreads by the deltas you choose. So I'm trying to do relatively tight spreads when I, for this, for an example. But you can see in the past 2 years, this makes, kind of makes sense, right? Delta 48 is pretty close to the money, had about an 80% win rate. The risk was 586. So that's typically a 1 or 2 strike spreads. They change a little bit. And, it made $800. So on the risk that you took, it made 140% the last couple of years. If I click into this, I can say, okay, the average win was about $100 and the average loss was $300. So again, the losses are still bigger than the gains, but the win rate is high enough to outpace that. So these are some of the results for the 2 years. The one that I end up with that I prefer, because I like selling out of the money for when we're selling, again, we're selling 30 days out here, is the low delta 30. So I did a delta 31, and you can see the actual increase in profit there. And part of that is because you get a little bit more trades. And I'm not going to get into all this the semantics of that, but when you're selling out the money, the at the money options do not they don't decay as fast. So when you're selling out of the money, the decay is faster. Therefore, when you're immediately opening trades, this strategy, for the same strategy but different deltas, was able to pull in 44 trades, where the at the money trade was closer to 35. So you got more trades because you were able to collect the profits faster because they're out of the money, and the ones that stayed out of the money are going to go, you're going to get that 50% gain a little bit faster. So that's, there's a little bit of as you go farther out of the money, that's going to happen. I think there's some danger getting too far out of the money, but again, that's probably for another video. So let's go ahead and let's click on the 10 year. And that's going to start trending. This is going to take a minute. I'm going to pause the video and I'll come back when it's ready. All right, so we finished up here. That took about 3 minutes, but I wanted to cut it out of the video. So now, over the past 10 years, again, whenever you see the technicals here in the middle, whenever the stock, in this case SPX, was above the 50 MA, it sold these various delta-based put spreads and took profits at 50%. So something a little bit different here. The way that this software, what I've sort of come to figure out is when we get to the data that's older, if there were options that may not have had a lot of activity or volume, they might have been excluded. And what that means is that it widened the spread out. So now our risk is a little bit more. Our average risk was, for at least the Delta 31, was almost $2,000. That's a four strike width spread. So I just wanted to, I just want to point out that over time, the width of the spreads can change. And I'm not sure why it does that, but in general, the same axiom kind of holds true, that if you look at the money options, 132 plus 34, there was 164 trades. And because it's at the money, still 80% still pretty good. I know it's a bull market, but still, that's 166 trades. But as we go farther out of the money, we ended up with 220 trades. So it was more trades, more money. You're able to get the profit faster by closing it at 50% of the gain and then immediately reopening the trade. Now, I know that the last 10 years, I'm doing this video in February of 2019. I know the last 10 years has been very bullish with some sideways action, but here's the thing is we're only trading the spread, or the software's, only trading the spread when it's above the 50. So even when the bear market comes and the market's below the 50, you simply don't trade this strategy. So this is just one of those, conditional things. They talk about this a lot in the books and all the other, option gurus and sites and stuff, is you want to know the right market condition. So the market condition to trade this particular bull put spread is being above the 50-day moving average, which makes pretty much sense, right? That means if the market's over the 50-day moving average, there's some kind of bullishness going on. So and then you play the probabilities here using Delta 30. So let's go ahead and take a look at the financial crisis. They have a special section here. I'm going to click on this and we're going to let it churn again. You can do this for any strategy. While this is churning, I will say that, you can put all the tickers in here. I know I focus on SPX a lot here on my channel because I like trading the indexes, but you can do Amazon, Apple, all the other tickers here. So this is interesting, right? So now during the bear market, the 2007 through 2009, bear market, the Delta 30 strategy was still profitable and actually did pretty well. It was only, wasn't out of the park like the bull market, but still it's worth considering this type of strategy. And, it only had 43 trades. And again, it's the same thing, same thing over here. The at-the-money options did not do well. They lost money because you're so close to the money that the probabilities are not in your favor. So by continuing to trade a bull spread above when the market's above the 50-day moving average, and coupling that with the high probability of an out-of-the-money option, that's what makes this strategy, in my opinion, profitable with whichever market you're in. So there's some little, Delta 31 puts. Here's some stuff they tell you about the pricing back then. But I thought that was interesting to, add this to your repertoire. If you're in a bull market, if you're above the 50, and again, you can get the software. I'm going to be continuing to look through this and see, because again, we're trying to increase our number of trading opportunities that have been back tested, that have worked over time. And I thought this was a pretty cool thing to share. Let's go ahead and I'm going to go back to the 10-year and I'm going to go ahead and put the RUT in here because I know we talked about that. The RUT actually did better, and I'm going to let this churn and I'll come back when the RUT results are in. All right, so we're back with the RUT results, and the RUT results were actually even better. Now, partly because they were able to keep the spread smaller. So $830 risk means the average trade was 1 to 2 strikes wide, because again, they're in $5 increments, and had a 90% win rate with 900% gains on the risk. That's not your whole account. Don't get excited. But look at the number of trades here, and that's what we're trying to do. Keep our risk small, our win rate high, and our number of trades large. And over time, those probabilities should be playing out for you. I'm going to click on this one so we can just see. We had an average win of $99, and the average loss was $500. So, this is going to happen. If you're just setting the limit order to buy it back, and then the market turns south, and you got a 2-strike spread on there, you can lose a few, you can lose $500 there if you got a 2-strike spread. So you really need to position this correctly so that you're ready for this. But again, over time, by staying consistent and maybe just doing 1 spread or 2 spreads at a time, whatever you're comfortable with, you know what the risk is before you go in, that you can have 2 or 3 losers in a row. So if you have 2 or 3 losers in a row like this, then you need to be prepared for that. Now, you could have 30 winners in a row. I'm not saying that happened. I haven't looked at the distribution here, but the point is, over time, by taking profits early, you're going to keep your win rate high, and you're going to be able to reopen the trade and just let the probabilities, kind of work in your favor. Real quick before we go, let's switch over to the charts and let's look at one of these setups. We just took one of these setups with my Patreon members. If you haven't joined already, I definitely recommend you do that. Check the description or go to the front of the YouTube page and become a patron, and you can see when we're trading these. And let's switch over to the platform right now. All right, so let's look at the chart and just see how this trade works. I have one indicator, that's the simple moving average. It's set to 50. I'm looking at the daily chart of the RUT. And basically, once the market is above the 50-day moving average, you would enter into a put credit spread about 30 days out with about a delta 30. So we took a similar trade yesterday. We did SPX, but let's just say that today was the day that we made the profit on the other one, and we're going to enter the new trade today. So we would go to the trade tab, and we would find the expiration with about 30 days. So right here, we have 28 days, and we're going to go to the puts delta. We have a delta 31, and I would sell this vertical. There we go. So for this particular one, if the trade was today, it's not. This was a one strike, and you can decide how wide you want to go, one or two strikes. But basically, for this one strike spread, we would get about $1.20 or $120 for the spread. So that puts us at 1560. So if you wanted to kind of draw that in, you could say, okay, here's where the put spread would be. It does seem like it's a little bit close, but that's what you got to get used to. So this is 1560. It's about 30 points away. And you would just set a limit order to buy the spread back for 60 cents or 60 bucks. That's 50%. If it goes through it, you would just wait. And then, the way I kind of factor things in is I like to sell spreads on down days so the volatility is higher. You could wait for that. But again, the volatility is getting crushed today, so this probably wasn't the best day to do it. But regardless, that's all this is. You're selling a put spread with the idea that when the market's above the 50, it's bullish and it's going to stay up for the next 30 days. Or, what I've seen with some of the results, typically these trades close in about 2 weeks because you're taking about half the credit. If you sold the spread here and the market rallied 5 days in a row, it's going to be closed with your 50% gain, and you're going to open a new one. That's why some of those results showed so many trades, because when market does, go up for a few days, then you can collect that premium faster. So that's it. Check the description of the video if you want to get the software yourself. Consider subscribing to the channel, and if you're interested in trading along with me, that'd be great. And check me out over on Patreon. You guys have a great day. See you at the next video.